Dear students,
while deciding about the debt and equity composition as part of its capital structure, a firm always considers the effect of earnings before interest and taxes on the EPS.
after listening to this lesson video, you'll be able to understand about the EBIT and the EPS analysis. EBIT, earnings before interest and taxes. EPS, earnings per share analysis, is the analysis on the sensitivity of EPS to changes in earnings before interest and taxes, shortly called EBIT, under different financing alternatives. Now let us get into the details of EBIT and EPS analysis.
Let us consider the financial data of Falcon Limited. Its existing capital structure comprises of 1 million equity shares of ₹10 each, and its tax rate is 50%. Falcon plans to raise additional capital of ₹10 million for financing its expansion project. For this purpose, it is evaluating two alternative financial plans. Alternative 1, issue of equity shares, 1 million shares of ₹10 each. Alternative 2, issue of debentures at 14% interest. Now let us look at the effect on EPS if EBIT is assumed at two levels, ₹4 million and ₹2 million. Now let us get into the calculation of earnings per share under alternative financing plans. Plan A is equity financing and Plan B is debt financing. So the earnings before tax is assumed as 2 million and 4 million in both the cases, or in both the alternatives of financial plan. Against the earnings before interest and taxes, interest obligation is to be adjusted. In case of equity financing, where entirely the project is proposed to be financed through equity, interest obligation will not arise. Whereas in case of debt financing, for the expansion project, the project cost of ₹10 million would be financed by issue of debentures at 14%. In such case, the interest obligation will be 1,400,000, which should be again adjusted against earnings before interest and taxes. So the balance, that is earnings before taxes, will be, in case of equity financing, will remain the same, whereas in case of debt financing, it will be 600,000 and 2,600,000, where the EBIT is ₹4 million. From this, we have to adjust the tax obligation at the rate of 50% on the earnings before tax. So, which will be, in case of equity financing, 1 million for the earnings before tax of ₹2 million, and it will be 2 million where the earning before tax is ₹4 million. Whereas in case of debt financing, it will be 300,000 and 1,300,000. So now the balance should be extracted, which is called the earnings after tax. That is, the remaining portion of, after adjusting the tax obligation, will be ₹1 million and 2 million in case of equity financing. Whereas in case of debt financing, it will be 300,000 and 1,300,000. So the number of equity shares, in case of equity financing, already as per the existing capital structure, the firm has 1 million shares outstanding. Now, to meet the requirements of expansion project, the firm is going in for additional issue of 1 million. So totally it will be 2 million shares in case of equity financing. Whereas in case of debt financing, the number of shares outstanding will remain as only 1 million, because the cost of expansion project is proposed to be funded through debentures. So the number of shares outstanding will remain the same. Now the earnings per share can be calculated by comparing the net earnings, nothing but earnings after tax, divided by number of equity shares. So 1 million rupees of earnings to be divided by 2 million shares. So the earnings per share will be 50 paisa per share in case of EBIT of 2 million and 1 rupee in case of EBIT of 4 million. In case of debt financing option, the earnings per share will be, when the net earnings is rupees 300,000 to be divided by 1 million shares, it will be 30 paisa per share. And when the EBIT is rupees 4 million, your net earnings will be 1,300,000 to be divided by 1 million shares. In such case, the earnings per share will be 1 rupee 30 paisa per share. So, if the firm is planning for all equity financing option, earnings per share increases when there is increase in EBIT, that is earnings before interest and taxes. Whereas for the same level of EBIT, comparing with equity financing, when the firm is planning to go in for debt financing at an EBIT level of 2 million rupees, the earnings per share has declined from 50 paisa to 30 paisa. Whereas when the firm is going in for debt financing and when the earnings before interest and taxes is 4 million, the earnings per share is maximized to 1 rupee 30 paisa. Now let us understand about the break-even EBIT level. Nothing but indifference EBIT point. So we are trying to find out by calculating the break-even EBIT, the level of EBIT that the firm should achieve to reach the same level of EPS under different financing options. So break-even EBIT is the indifference point of earnings before interest and taxes of two alternative plans. It is the level of EBIT, that is earnings before interest and taxes, for which the EPS is the same under two alternative financing plans. So the EBIT indifference point or the break-even EBIT level can be obtained mathematically using the following equation, taking into account the two alternatives. So we are trying to match the EPS. We want to achieve the same level of EPS, for which what should be the amount of EBIT to be achieved by the firm is the objective here. So the one component where there is all equity financing, the other component is debt financing option. So in this equation it is mentioned that the EBIT to be identified, indicated as EBIT star minus interest if any in the first option. That means that will give you earnings before tax, against which the tax obligation is to be adjusted and divided by the number of shares as per plan 1. That will give you the EPS. And we are arriving at the earnings before interest and taxes to have the same EPS, taking into account the values of both the plans or both the alternatives. So here the EBIT mentioned with an asterisk mark is nothing but the EBIT indifference point between two alternative financing plans. And I1 and I2 are the interest expenses under financing plans 1 and 2, and T is the tax rate. And N1 and N2 are the number of equity shares outstanding under financial plans 1 and 2. Now let us calculate the break-even EBIT level for Falcon Limited. It is nothing but the earnings before interest and taxes indifference point. That is the EBIT that must be made where the EPS will remain same in both alternatives or both alternative financing plans. So using the following equation, we can calculate the EBIT. So we have substituted the information in the equation. In plan A or in equity financing plan, your number of equity shares will become 2 million and without interest obligation. Whereas in the other option, debt financing option, your number of equity shares will remain 1 million, whereas you will have interest obligation of 1,400,000, which is nothing but 10% on 10 million. 14% on 10 million. And the tax adjusted earnings, net earnings will be divided by the number of equity shares. So by simplifying the above equation, the EBIT is calculated. So to simplify the equation, first the following equation is derived by cross multiplication. And this equation is further simplified like this. And the EBIT to be achieved, to attain the same EPS, is to be calculated by simplifying this equation. So which will be 2,800,000. Now let us check by substituting this EBIT whether the firm is in a position to maintain the same EPS in both the plans. So now let us calculate the earnings per share, break-even EBIT or indifference value level for Falcon Limited. So in case of equity financing, your EBIT will remain same for both the plans, 2,800,000, what we have now calculated using the equation, against which the tax obligation is to be, the interest obligation is to be adjusted at the rate of 14% on rupees 10 million. So in equity financing, the interest obligation will not be there, whereas in debt financing, 1,400,000 to be adjusted. So the earnings before tax will be in equity financing, it will be 2,800,000, whereas in debt financing, the remaining portion after interest obligation will be 1,400,000. From this, tax is to be adjusted at the rate of 50%. So it will be, in case of equity financing, 1,400,000, whereas in debt financing it will be 700,000. So the earnings after tax will be the remaining 50%, 1,400,000 and 700,000, and this should be adjusted against the number of shares, divided by the number of shares. So the number of equity shares in case of equity financing will be 2 million, because as per the existing capital structure, you have 1 million shares outstanding, and to finance the expansion project, you are planning to issue additional shares of 1 million. So totally you will have 2 million shares outstanding. Whereas in case of debt financing, it will be only 1 million shares. Now the earnings per share can be calculated by dividing earnings after tax by the number of shares. So 1,400,000 divided by 2 million will give you 70 paisa as earnings per share in case of equity financing. Whereas in case of debt financing, it will be 700,000 divided by 1 million shares. The earnings per share remains the same. So the indifference earnings before interest and taxes level, EBIT level, indifference EBIT level can be obtained graphically. It is shown graphically in plan 1 and in plan 2 at an EBIT of 2,800,000. The EPS is same, rupees 70 paisa per share, no matter the financing alternative that the firm follows, even if it is equity financing or debt financing. So from this, how a firm or the finance manager of the firm may have to make decisions. So what does this EBIT and EPS analysis indicate? So a broad indication may be obtained. So the finance manager has to do two things here, and in fact two observations are to be made on two aspects. First one is compare the expected value of EBIT with the indifference value, and second, assess the probability of EBIT falling below its indifference value. Now let us look at the risk considerations. If the most likely value of EBIT exceeds the indifference value, debt financing option may be advantageous. The larger the difference between the expected earnings before interest and taxes and the indifference value, stronger the case for debt financing. Given the variability of EBIT due to business risk, probability of EBIT falling below indifference value may be assessed. In such case, if such probability is negligible, debt financing option would be advantageous to the firm. If such a probability is high, that the probability of EBIT falling below indifference value is high, debt financing alternative may be risky to the firm.
Dear students, I hope you would have gained knowledge about EBIT and EPS analysis, the sensitivity of EPS to changes in EBIT, and different financing alternatives.
Now let us consider another example to understand about the EBIT and the EPS analysis. The company Modern Chemicals Limited requires rupees 25 lakhs for a new plant. The plant is expected to yield a EBIT, that is earnings before interest and taxes, of rupees 5 lakhs. While deciding about the financial plan, the company considers the objective of maximizing earnings per share, in short called EPS. It has three alternatives to finance the project: by raising debt of rupees 2,50,000, or rupees 10 lakhs, or rupees 15 lakhs, and the balance in each case by issuing equity shares. The company's share is currently selling at rupees 150, but it is expected to decline to rupees 125 in case the funds are borrowed in excess of rupees 10 lakhs. The funds can be borrowed at the rate of 10% up to rupees 2.5 lakhs, at 15% over rupees 2.5 lakhs and up to rupees 10 lakhs, and at 20% over rupees 10 lakhs. The tax rate applicable to the company is 50%, and you are asked to find out which form of financing should the company choose. So this is how the facts of the case will be given. So the company has a proposal. The company has an investment proposal for rupees 25 lakhs. It is planning to put up a new plant at the cost of rupees 25 lakhs with an yield, expected yield, it's an estimated yield of rupees 5 lakhs. And the objective of the firm is to maximize earnings per share. And it has three alternatives to narrate it. The first option is they may go for raising of debt for rupees 2,50,000. That means for the remaining of 22.5 lakhs, they will go for equity financing. And in the second alternative, they are planning to raise debt of rupees 10 lakhs. That means for the remaining of 15 lakhs, they are planning to go for equity financing. And the third alternative, they are planning to raise about 15 lakhs. That means for the remaining of 10 lakhs, they are planning to go in for equity financing, or they are or raising funds by issue of equity shares. And the current selling price per share of the company is given as rupees 150, and it is expected to decline to rupees 125 in case the funds borrowed in excess of rupees 10 lakhs. That is in the alternative 2 and 3. So from the facts of the case question, we observe that the company Modern Chemicals Limited is planning to put up a new plant at the cost of rupees 25 lakhs, and the estimated earnings before interest and taxes is given as rupees 5 lakhs, and the objective of the firm is to maximize earnings per share. So it has three alternatives. They can either, first alternative is go for borrowings of rupees 2.5 lakhs. That means the remaining 22.5 lakhs out of this 25 lakhs will be raised by way of equity. And in the second option, this is your second option of going in for borrowings of rupees 10 lakhs. That means the remaining 15 lakhs from the investment, original investment of rupees 25 lakhs, the balance of 15 lakhs will be raised by issue of equity. And the option number 3 is that the company is planning to go in for a borrowing of rupees 15 lakhs, which means the equity will be at rupees 10 lakhs. So the company's share is currently selling at rupees, this is current price, 150 rupees per share. And it may fall, it is expected that it may decline to 125 rupees if the borrowings are more or in excess of rupees 10 lakhs. So the funds can be borrowed at 10% up to 2.5 lakhs. The interest rate, the rate of interest at which the borrowings can be made is given as 10% if your borrowings are up to 2.5 lakhs. And it may increase to 15% if it is between 2.5 lakhs to 10 lakhs. And in excess of 10 lakhs, that is over and above rupees 10 lakhs, the interest rate may be at 20%. So there are three interest rates given, which will vary depending upon your amounts of borrowing. If it is up to 2.5 lakhs, it will be 10%. Between 2.5 lakhs to 10 lakhs, it will be 15%. And over 10 lakhs, it will be 20%. And the tax rate applicable to the company is given as 50%. So you are asked to find out which financing, whether option 1 is better to achieve your objective of EPS, or option 2 is better, that means 10 lakhs of borrowing and 15 lakhs of equity would be helpful to achieve your objective of maximizing EPS, or the third option would be better. So which among the three the company should use to achieve its objective is the question. Now let us look at the determination of interest. In case of plan 1, firm is planning to raise in the form of borrowings for rupees 2.5 lakhs at an interest rate of 10%. So the interest obligation in case of plan 1 will be rupees 25,000. In case of plan 2, the firm is planning to raise rupees 10 lakhs as borrowings. So it is given in the question that up to 2.5 lakhs, it is given that up to 2.5 lakhs, the interest obligation will be 10%, and above 2.5 lakhs, it is going to be 15% up to 10 lakhs. So any amount borrowed between 2,50,000 and above, and a maximum of 10 lakhs for which the interest obligation will be 15%. So calculating 15% on 7.5 lakhs, you get an interest of 1,12,500 per annum. So put together, totally your interest obligation, if you go for plan 2, will be 1,37,500. In plan 3, the firm is planning to raise around 15 lakhs. So if we split it into 2 lakhs at the rate of 10% and up till 10 lakhs over 2.5 lakhs is 15%, and excess over 10 lakhs, the interest rate given in question is 20%, at the rate of 20% on 5 lakhs. So it will be rupees 1 lakh, and 15% on 7.5 lakhs will be 1,12,500. So all put together, your interest obligation, if you go for plan 3, will be 2,37,500. So we have calculated now the interest obligation for various plans. Now let us look at the number of shares to be issued in all the 3 plans. First, let us consider plan 1. In case of first plan, the firm is planning to raise borrowing by rupees 2.5 lakhs. That means the firm is planning to go in for equity for 22.5 lakhs, and the current market price given is rupees 150. So by dividing the amount of equity financing, this is going to be your equity financing, rupees 22.5 lakhs, and if the current market price is 150, that means you may have to issue 15,000 shares in case of plan 1. If it is plan 2, you are planning to borrow 10 lakhs. That means your equity component in the capital structure will be plus 15 lakhs. If it is divided by the market price of 150, we observe that the firm may have to issue 10,000 shares if the firm is planning to go in with plan 2. If it is plan 3, the company is planning to raise 15 lakhs by way of borrowings. That means equity component will be rupees 10 lakhs. And it is given in question that the market price per share will be rupees 125 if borrowing exceeds rupees 10 lakhs. So by dividing the equity component by 125 rupees, we observe that the firm may have to issue 8,000 equity shares if it plans to go in for plan 3. Now let us calculate earnings per share under proposed financial alternatives. Alternative 1, as we know already, involves raising of debt of rupees 2.5 lakh and equity of rupees 22.5 lakh. And alternative 2 involves raising of debt to the tune of 10 lakhs plus equity rupees 15 lakhs. Alternative 3 involves raising of debt of rupees 15 lakhs and equity of rupees 10 lakhs. And it is given in the question that the earnings before interest and taxes of rupees 5 lakhs. So it is commonly taken for all the 3 plans. From this, we have to subtract the interest obligation. So based on the working, we have already calculated the amount of interest for all the 3 alternatives. In case of plan 1, it is 25,000. Plan 2 is 1,37,500, and plan 3 is 2,37,500 as per the explanation given earlier. So after subtracting interest, the earnings before tax will look like this. It will be, in case of plan A, it is 4,75,000. Plan B, it is 3,62,500, and plan B, it is 2,62,500. So from this, we have to subtract taxes, the tax obligation, at the rate of 50% on earnings before taxes. So out of 100 rupees of earnings, rupees 50 will go towards tax. So out of 4,75,000, 50% of which 2,37,500 will be paid towards tax. Similarly, the calculation for the other 2 plans have been made and the tax amounts are shown there. So after subtracting taxes, you will get the earnings after tax, which will remain the same. Since your tax rate is 50%, the balance will be earnings after taxes, which is nothing but net earnings available to equity shareholders. that is after meeting all the obligations, interest obligation, the tax obligation, whatever amount, the residual amount will belong to equity shareholders. It is shareholders' earnings. So if you divide it by the number of shares, we have already calculated the number of shares for each plan. In case of plan 1, we are planning to raise 22,50,000 by issue of shares. So if we divide it by 150 rupees per share as market price, and we have calculated that we may have to issue 15,000 shares. In case of plan 2, it's going to be 10,000 shares because we are planning to raise 15 lakhs by issue of shares, and if the market price is 150, we may have to issue 10,000 shares. And it is given in question that if the firm's borrowings are to exceed rupees 10 lakhs, here in plan 3, we are planning to raise debt by rupees 15 lakhs and equity by 10 lakhs. So because of which it was expected that it was given in the question that the market price would decline from 150 to 125. So we are dividing rupees 10 lakhs by 125 rupees as market price per share, and we arrived that the firm may have to issue 8,000 shares in case of plan 3. So taking this into account, we can calculate earnings per share. So there are 15,000 shares, or the company may have to issue 15,000 shares for a net earning of 2,37,500 in case of plan 1 or alternative 1. So per share has earned 15 rupees and 83 paisa, and earnings per share in case of alternative 2 will be 18.13, 18 rupees 13 paisa. So it is nothing but 1,81,250 divided by 10,000 shares. So per share has earned 18 rupees and odd. And in case of plan 3, earnings per share is 16 rupees and 41 paisa. So now let us look at the recommendation. The recommendation is that financing option 2, that is raising a debt of rupees 10 lakh and equity of rupees 15 lakh, is the best option. Financing option 2 is the best option as it maximizes the earnings per share. Because in case of alternative 2, your earnings per share is the maximum comparing with the other 2 alternatives. So financing option 2 is the best option, is the recommendation. I hope after listening to this video, you are able to understand about the importance of EBIT and the EPS analysis, and about the break-even EBIT. Thank you.